there. Greetings, traders and investors, and welcome back as always. Ben at Tyndall, tradinganalysis.com. It's Friday, March 11th, 2022, and I wanted to take just a minute of your day to invite you to an upcoming webinar event we have taking place tomorrow, Saturday, March 12th. This will be held at 9 a.m. Pacific, noon Eastern, and in this webinar event, we're going to tackle the recent market volatility that we've seen. Now, there's been a lot of uncertainties from inflation and the Fed to now, of course, the geopolitical uncertainties with the Russia and Ukraine situation, and many of you are left wondering if this is the start of a larger bear market trend. We're going to look to answer that exact question tomorrow. Again, tradinganalysis.com/webinar to get signed up. Hope to see you there. Now, before you get signed up for the webinar, let's take a quick minute to review price action in the S&P 500. We'll go full screen on the charts and take a look at the weekly time frame going all the way back to the credit crisis lows in 2009. It's in 2009 that we see the S&P 500 begin a cycle degree 5-wave trend. We rally in 5 waves, completing our first wave 1 in April of 2010. We then proceed to enter a sideways flat consolidation, which completed September 28th of 2011. And from there, we can count a beautiful 5-wave trend, which completes in September of 2018. The Wave 3 objective of 28.55 was actually exceeded as the September 2018 intraday high was 2940.91. I don't think I will ever forget that number. Zooming in and focusing in on price action from the 2018 high, we'll go ahead and get off of the weekly and take you down to the daily chart. You can see the yellow circle for context. Looking at price action from the 2018 high, notice the S&P 500 has a 3-wave decline, which completed December. From the December 2018 lows, we rally in 5 waves, consolidate in a sideways triangle, and then break higher in Wave C. One key area that I want you to pay attention to is the Elliott wave trend channel offered from the cycle degree of trend. Now, there are multiple ways to draw trend channels. You have base channels, etc. In the world of Elliott wave, there are 2 distinct channeling techniques that we utilize. Those include the 132 channel, and in this case, the 243 channel. We use the 243 channel in combination with upside fib projections to determine when and where our wave 5 might meet resistance. So coming off of the September 2018 highs, and we're going to get off of the weekly once again down to the daily. Down to the daily. There we go. From September of 2018, September, October, into December, 3 waves back into February of 2020. Then the coronavirus came along and set the social mood up for an impulsive decline. The impulsive decline met resistance into the expected fib support zone and also paired up in time to the wave 2 counterpart of the same degree. From there, we have an established 2, 4, 3 Elliott trend channel, or said otherwise, you take a trend line from the low of 2 through the low of 4, projecting your parallel trend line over the top of the wave 3 position. Off of the weekly back down to the daily, I want you to notice that the first 5-wave trend coming out of the COVID low met resistance into the upper boundaries of that cycle degree trend channel. We then consolidate in a 3-wave Elliott wave flat correction and then proceed to rally in another 5 waves, this time meeting resistance January 4th of 2022. Now, in the most basic of Elliott wave terms, we have an initial actionary wave, a reactionary corrective wave, and then another 5-wave move into 2022. Within our orange primary degree wave 3 position, we have 2 corrections of the same degree, which do tend towards equality. And in addition to tending towards equality and being equal in magnitude, we see slight alternation in the style of the correction. This tells me that the best case wave count would suggest up in 1, down in 2, rally in wave 3, and we're now in a wave 4 position pairing up to our wave 2 flat. Now notice the trend channel that we broke above, we are just shy of back testing. Additionally, we have a micro gap on the chart from April of 2021, which was never filled at 4020.63. We're now going to get off of the daily and take you down to the smaller time frame. taking you off of the daily down to the 1 hour chart. Looking at price action from January 4th, we see two distinct possible interpretations of our orange primary degree wave 4. The first count would suggest that we had a 5-wave move with a truncated fifth completing January 28th. From there, we have 3 waves back, meeting resistance between the 50 and 61.8% retracement of our January 4th through January 28th decline. From there, we are tracing out a 5-wave sequence to complete wave C of orange primary degree wave 4. This view would be confirmed on a break south of 41.1465 and open up the door for a move back to 40, 50, and as low as 4,000. Alternatively, taking you to our blue count, we finished our orange primary degree wave 4 correction with a complex, which is essentially a combination of Elliott wave corrective patterns. In this view, the February 24th low did in fact mark the end of the wave 4 correction, and we are in the process of attempting a trend reversal. Now, this chart is looking a bit questionable, and we are leaning more in favor of a break south towards 4,000. But in the event we do break south of 41.14 and move towards 4,000, we would not be immediately adopting the bearish count that so many Elliotticians are utilizing at the moment. And those wave counts would suggest that our cycle degree wave 5 actually completed in January of this year. If cycle degree wave 5 completed, that means we actually have a 5-wave structure from the credit crisis lows that's complete. That would allow for a more significant retracement of this move and could potentially take us back south of 2,500, possibly south of 2,450, maybe even down to 1,800. But that's not our view. Our preferred view of markets suggests that we are in a wave 4, and we will see one final break higher in wave 5 up towards 5,100 to 5,400 as our upside zones of resistance, and then we will be set up for the more significant market correction. Now, what happens if we're wrong and we break south of 4,000? Would we immediately adopt the count and the view that says cycle wave 5 is over? Absolutely not. Absolutely not. Again, let me reiterate my view that price action from the COVID low is best described as a 3-wave trend. 3 waves does not complete a trend or finish a higher degree structure. In this instance, here's a good illustration of that going back to the December 2018 low, where we have a 3-wave move which did yield a 5-wave decline. Without the context of the higher degree wave 4 flat correction, one may have interpreted that 5-wave decline to be the start of a more significant bear market. Now, going full screen again on the charts, if this is in fact 3 waves, what's the alternate view? In the event the wave 4 in our primary or preferred count is violated and we break south of major fib support, we would be adopting a view which would allow for a more significant retracement of the post-COVID low rally, but not of the full post-credit crisis low breakout. That means price action would remain north of 2191.86 and more than likely meet support somewhere between 35.66 and 29.61. But really, it's fair game all the way down to 25.94. Let's call it 2600. Now, if this count is truly at work, we'll have the evidence to suggest that's the case soon. And this is an instance where it would come in handy to have an understanding as to the various subdivision possibilities. So again, I hope to see you guys join us tomorrow, Saturday, March 12th, 9 a.m. Pacific, noon Eastern. You can go to tradinganalysis.com/webinar to get signed up. And we'll see you guys in the webinar, and I'll catch you on the next public update. Take care.